Geopolitical shocks have become a structural feature of the backdrop. They raise volatility, they make fundamentals more fragile, and challenge traditional diversification, which makes spreading risk across multiple return drivers increasingly important. Within equities, geographic diversification is key. High concentration in the US and the AI theme leaves portfolios exposed, while valuation dispersion and decoupling cycles create asymmetric opportunities across developed and emerging markets. In that environment, we focus on our best high conviction ideas, including structural themes such as US reindustrialization and supply chain realignment. In fixed income, duration is a less reliable diversifier despite higher yields, requiring a more selective and more flexible approach. In commodities, gold remains a structural hedge in a fragmented world with unstable bond-equity correlations, and we favor selected real assets such as copper, supported by electrification and AI demand. From a hedging perspective, when volatility is low, we look to use the full toolkit at our disposal, including options, to build protection proactively rather than reactively. Resilience comes from diversification, from flexibility and disciplined risk management, not reliance on any single hedge. Global growth remains on solid footing, although we need to remain watchful of Iran-related developments. China is stimulating, and Germany has entered fiscal austerity. The cycle is underpinned by a resilient US consumer, with activity picking up beyond the US, happening in Europe and happening in parts of emerging markets. That environment supports maintaining a positive equity stance. Earnings remain resilient, and the expansion is actually broadening, but elevated valuations and concentration risks means selectivity is key. In credit, we remain cautious. Spreads across both investment grade and high yield markets are very tight, while the news flow from private debt is increasingly troublesome. Overall, we're constructive on risk, but disciplined on valuation and also hedging. A clear example of the strategy's flexibility was around Liberation Day. Ahead of the event, we used relatively calm market conditions to build sizable downside protection across the US and across European equities through put options, with notional exposure well over 20% off equity. When markets corrected and volatility spiked, those puts appreciated significantly, reducing portfolio equity beta by about 0.3 levels. This is almost 20-30% in equities. As conditions stabilized, we bought the dip, taking profits on the deeply in-the-money puts, which mechanically added back to equity beta. But we also redeployed capital, mostly into credit, where spreads had widened materially from very tight levels, and selectively also added to equities at more attractive valuations. This dynamic adjustment is possible because options provide downside protection, cost efficiency, capital efficiency, and flexibility. Clear advantages over simply raising cash to hedge.